Hey guys, as you have been in this channel for a while, I don't usually recommend growth stocks, especially those making losses yet still have high valuations, even though I may review some of them sometimes. So why am I starting to monitor Teladoc Health more closely now? Well, first of all, there's been some 50% correction in the recent months, so it alerted me to investigate further. Secondly, I'm actually optimistic about telemedicine in general, though I was skeptical at first because I thought what Teladoc is providing is pretty commoditized, like a Zoom meeting session with your doctor. Even so, I personally think it is a great commodity as a user. As an investor, of course, we need to consider how the company can build its competitive advantage and moat around its businesses. So today, I'm going to quickly run through with you the valuation that Teladoc is standing at today and how Teladoc is moving from just Zooming with doctors to a more comprehensive high-tech telemedicine provider. Anyway, the terms telehealth and telemedicine have been used interchangeably, though to be specific, telemedicine is a subset of telehealth. So from here onwards, I will use the term telehealth to address the market we are talking about today. Basically, telehealth involves the broad scope of using technology to provide remote healthcare services and even non-clinical services like healthcare providers training and administrative operations. On the very surface level, you can imagine it as patients using electronic communications for medical consultation with their doctors, but of course, that's the very basic function and commoditized service. Telehealth involves more than that. We will discuss that in more details later. First, understand that the usage of telehealth has been accelerated due to the outbreak of COVID-19 back in 2020. Observe from the chart, telehealth claims volume is stabilizing at 38 times that of the usage compared to pre-COVID-19 levels. But as of now, bearish investors are saying that once the pandemic comes under control and we revert to normal life to a time before COVID, we are going to see a decline in the usage of telehealth. Personally, I think that yes, this accelerated adoption of telehealth may see some pullback in the utilization rate in the short term. But think about it, say in a post-COVID world, one day you wake up having a headache or a common flu, all you need is probably 2 pops of Panadols and some rest. Would you want to go to a clinic to see the doctor for a 30-second consultation? Sometimes you probably have to wait for an hour for that short consultation with your doctor and then wait again for your medication to be prepared. Or perhaps you may have encountered having to bring your aged parents or grandparents for regular reviews with the doctors every 3 months, where the doctors will just have a chat with you to check on any irregularities observed over the past 3 months. Most of the time, there's no complex measurement or treatment that needs to be taken during such reviews. At most, probably a measurement on the blood pressures is what's required. And telehealth can really help save time and cost by reducing or doing away with such physical visits. Of course, not all visits to the doctors can be eliminated, so this brings me to the study by McKinsey. According to the research, based on the current spending of $1.25 trillion on outpatient, office and home health, 20% of it can potentially be virtualized. In other words, the total addressable market for Teladoc is potentially up to $250 billion. And Teladoc's clients are namely employers, health plans, hospitals, and insurance companies. The reason why they want to work with Teladoc is because it helps them save money. For instance, according to Veracity Analytics, Teladoc's clients saved $472 on average per general medical visit when its members received telehealth through Teladoc Health instead of receiving healthcare in other settings for the same diagnosis. In fact, the company's chronic care solutions have also been shown to provide significant average cost savings for their clients, including an average savings of $1,908 per participant per year in their Livongo for Diabetes program. Moreover, we are expecting the telehealth market to grow at a compounded annual growth rate of 25.2% from 2020 to 2027. So all in all, I will say that there's tremendous opportunities in the telehealth industry. And Teladoc is adding more features and solutions to provide a more comprehensive virtual care. As a matter of fact, it is still in the early stages of doing so. For now, its portfolio of services and solutions are already covering hundreds of medical subspecialties, from non-urgent episodic needs like flu and upper respiratory infections to chronic complicated conditions including diabetes, hypertension, cancer, and even congestive heart failure. Apart from softwares and AI technologies, the company also provides innovative hardware products to provide a more comprehensive care. For instance, members enrolled in the diabetes program will be provided with proprietary blood glucose meters and testing kits, in which the measurements will be sent to the cloud service. Combined with its proprietary machine learning software, it can display targeted and personalized communications and even AI's selected nudges to prompt users the next action step or what to look out for. And the company's vision is to position virtual care as the first place consumers go to get the care they need and manage their health. So, other than its virtual care delivery, Teladoc has made a $18.5 billion blockbuster merger with Livongo last year to expand its reach in the digital chronic condition and management solutions. Not only that, the company's proprietary license platform allows integration with traditional modes like hospitals' electronic medical records and connection with industry-leading medical devices. In short, the extent to which it can virtualize the healthcare industry is huge, and we are just scraping the surface of it. Not only that, most of the revenue the business is generating now is on a recurring subscription basis. So given all the optimism in the telehealth industry, why has Teladoc's share price fallen almost 50% from its peak of nearly $300 that it attained earlier this year? I think there's a few reasons. First will be the growing competitions from other telehealth players like Amwell, CVS and Doctor On Demand. In fact, with Amazon and Walmart joining the race, it has definitely caused investors to reconsider the competitive landscape and threats from these two giants. The second reason will be that its user base hasn't really been growing over the past few quarters, and this may worry investors of its growth prospects that the adoption of telehealth is only supported by the pandemic effect. In fact, they are afraid that utilization will even drop in a post-COVID world. And this is compounded by the soft guidance for the full year of 2021, although revenue is still estimated to be a 80 to 85% jump from the fiscal year of 2020, in which a good part of it will come from the merger with Livongo last year. That's because revenue for the first quarter of 2021 is already standing at $454 million. A guidance of $1.95 billion for the full year means that minimal growth is expected in the next few quarters. Similarly, the number of US paid members is expected to add only 0 to 4% from 2020's figures. Given that a substantial amount of growth projection was already priced into Teladoc's share price, the minimal growth is perhaps why some of its speculative trades were withdrawn, causing its share price to decline 50% from its peak of nearly $300 in February 2021. Valuation-wise, I think there will be too much variability to actually value Teladoc accurately, since the company is still making losses due to heavy investment like in sales and marketing to continue to grow its business. And although Teladoc is the leading player in the market, the telehealth industry is pretty much still in the early stage of growth and expanding fast, and that leaves much execution risk for Teladoc to continue maintaining its market leader position and even fend off competition from behemoths like Amazon and Walmart. But on a price to sales ratio basis, it has definitely come down from the high of 25 range to a more reasonable level of 12 currently. Hence, this definitely provides a better entry point than what we have over the past year. Anyway, just for a very rough estimate, using a revenue of $2 billion from the guidance by management for the full year of 2021, growing at an industry growth rate of 25.2% compounded annual growth rate through 2027, and assume a 15% net earnings margin and that PE ratio equilibrates to 30 by 2027 as the growth rate slows, then we should expect a target share price of around $225 by then. At the current share price of $150, this would translate to a projected compounded annual returns of less than 7%. Again, this is just a very rough estimate. Profit margin may be higher or lower, Teladoc may grow faster or slower over the next few years, and perhaps beyond 2027, the telehealth industry may continue to expand further. But at least from this rough estimation, we can see that at least the speculative bubble has been toned down, and Teladoc's share price is starting to look more interesting as a bet on the telehealth industry in general. Nevertheless, I'm still pretty positive on the long-term trend of the market for telehealth, and I think Teladoc is very well positioned to ride the wave. The company is moving aggressively to provide more comprehensive coverage for its users, from preventive care and chronic care to mental health care, to enhance its competitive edge against its users. With more solutions under one roof, it will create more stickiness for its users, as the last thing a patient wants to do is to switch around different technological platforms to resolve different medical conditions. So, although the growth in user base may slow down, there's ample opportunities for cross-selling different products to its members, especially with the merger of Livongo. As you can observe from the chart, Teladoc's per member per month fees have been increasing steadily over the recent quarters, and with the company continuously expanding into more products and solutions to provide a more comprehensive healthcare for its members, this metric will only go up in the future. So therefore, overall, I'm still very positive about teledocs and the telehealth industry in general. While we may have some pullbacks in the utilization of virtual care in the short term, I'm pretty positive in the long-term trend. Who doesn't want to save the time and cost of traveling to the clinics or hospitals if certain consultations or procedures can be done from the comfort of your home? And Teladoc is well positioned to ride on the wave of the telehealth industry. Its existing relationships with major medical institutions and insurance providers could help the company easily capture more users to its programs. As we have seen earlier, the healthcare spending that can potentially be virtualized is standing at $250 billion currently. Even if Teladoc maintains a market share of 5%, that will translate to a top line of $12.5 billion. And that should bring up its share price if it materializes, more than what we have projected based on our rough estimate, which may be on a more conservative side. Though I personally feel that there's still a lot of growth projections priced into Teladoc's share price currently, despite the 50% decline from its all-time high, the share price may stay elevated for a long time. Especially so in this healthcare industry that's ripe for disruption, and there remain many exciting opportunities ahead, just like how e-commerce changed the way we shop and live today. Therefore, I'm definitely watching Teladoc very closely and may perhaps initiate some positions when opportunity presents itself. Let me know your thoughts on this and share with us in the comments below, and remember to subscribe to our channel so that you can be informed once our next investing tip is out. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning and happy investing, and we will see you soon.